Good evening and welcome to the live stream event on the 1st of September 2020. This is the pre-show part, so I'll just stick the banner up to remind everybody that we haven't started the formal show yet. Great to have so many people on already. Good to see old names, new names, and a lot of interesting discussion already, even on the pre-show, about where prices are going and whether the Reserve Bank will keep rates low or whether they'll go up. Aussie dollar versus US dollar, interesting discussion there, particularly where the Aussie dollar is now, and a whole bunch of other things too. So we'll just keep this going for another moment or two, just to allow a few more people to come on. As always, we find there are a few stragglers coming in a little late, not surprising on the evening. And then we'll get started with the formal show. And to me, tonight it's just me. There's no guest tonight. That'll change next week, but I want to take you through some of the latest data from my surveys and also just cover some of the highlights from the announcements today. The Reserve Bank, of course, made their announcements, and we've also got updated information on consumer confidence and also some other data too. And as the data continues to come in, we continue to read the signs which suggest that the economy is still very much going to be in struggle mode for some time to come. And of course, that will have an impact on the property market. And it's good to see so many people on the show, and the numbers are rising. That's fantastic. So we'll go in about 30 seconds and get started on the formal show. Just to remind you that if you want to grab my attention, use that Walk the World. That'll make sure that I see your comment. And the fact of the matter is that always many things going on the chat, some of which I'm not able to cover, but Plexus, of course, is there to help with the moderating. And thanks, Plexus, for all that you do. It's really appreciated. Okay, well, with that, let's take the pre-show off. And I'm now going to run the intro, and when I come back, we'll start the show proper. See you in a second. Well, good evening and welcome to the Digital Finance Analytics live stream for the 1st of September 2020. I'm Martin North from Digital Finance Analytics, and I'm very pleased to welcome you to the show. Thanks very much for spending some of your Tuesday evening with me. And we've got a lot to get through tonight, as always. Plenty of discussion around the property market and specifically around financial stress. So we'll get started pretty much. There's so much to cover. And to do that, we'll just go over the running order for the day first. So as normal, we'll do the introduction, then the house rules, talk about our models briefly, go through a few key slides. During that part of the chat, I will be not looking at the live stream chat because I'll be actually talking to the slides. So if you want to make a comment or a question for me, you probably should hold off until after that. Questions and answers, that'll be the main part of the show. Obviously, if there's a question you'd like me to answer, I'll try. And I've also got a few loaded from earlier. And then we'll sign off. We'll finish about 9:30 or perhaps just a bit before. And in terms of the house rules, as I always say, understand this isn't financial advice. I'm not qualified to give financial advice. Don't take it as such. If you need specific tailored advice, go talk to a financial advisor. What I'm doing is just giving you the benefit of my research. What I'm trying to do is to empower you to be able to make better decisions by providing a platform of information, but it isn't advice. Secondly, do play nice in the chat room. No racial slurs, please. The stream is being moderated. Thanks, Plexus. Appreciate your help there. And as always, feel free to contribute in the chat with comments and opinions. I won't necessarily react to all of them, but if you do want me to react, then please use @WalkTheWorld to get my attention. And if you are watching this show later, this was recorded on the 1st of September 2020. The Super Chat has been enabled, and I see a few people already using it. So thanks to Nico, Yogi Bear, and Javier. Appreciate it. And there's two things. Super Chat allows you to make sure that your question goes to the top of the queue, so it's likely to get answered. And secondly, you can also help to make a contribution to DFA. Now, DFA isn't run for profit. We try to cover the costs, and that's all. And in fact, because of that, we really are reliant on people just making contributions through the various channels to help us to be able to cover the cost of doing this. There's quite a lot of time and effort and some money involved in making this content. And of course, we do put videos out every day. So just on the core market model, this is the fundamental building block of DFA. We have household surveys. They're running all the time. I did a post at the weekend talking specifically about the financial stress aspect of our surveys, but information is drawn from all sorts of different sources, goes into our core market model. The core market model is then crunched, and that feeds into all of the other things that we get to use, including our industry reports, including the YouTube, and including client-specific work. And we can think of that as another way, which is effectively it's a Rubik cube. We can turn the data into all sorts of different slices and dices to be able to look at different insights. And as we progress, these insights become richer as we begin to understand that there are diverse customers, diverse households, and diverse needs among them. And we try to bring some of that to life. Now, the analytic model also drives our scenarios, and the scenarios are a way of trying to talk about the future without necessarily being totally prescriptive about which future is going to come. That's because there are too many variables to be definitive. And you may remember that Steve Keen years and years ago predicted a 40% crash and then basically had to walk it back. What I've tried to do is to say there's a range of scenarios, and so those scenarios come out of the back of the model. It's an automated process based on all the inputs. And in fact, as I've been showing recently, our mortgage stress, the house price trajectory information, the buying and selling intentions, the migration data, and the economic wages, CPI, employment data, all feed into the core market model and drive our scenarios. Those scenarios in turn drive the postcode level data, can be rolled up to state, region, and Australia. And that allows us then to create these weird shaped charts which show you effectively the difference between the least case and worst case scenarios for a particular postcode. And here's just an example from Victoria. So my scenarios say that on a really good scenario, we will see prices in Victoria on average drop around 10% over the next year or so, drop a bit further, maybe another 4 or 5%, and then return in year 3. That's the best scenario. The worst scenario is a drop of 20% over the first year and down to more than 35% over 3 years. And my midpoint, which is, if you like, where the weight of the evidence sort of sits at the moment, says that there is a sort of a 10, 12, 15% fall followed by another fall. And at the end of 3 years would be down 24%. Now, that's on average. Units probably more than houses, different postcodes behaving differently. But we roll this up from the individual postcodes. Now, let me just cover quickly some of the news. So the Reserve Bank, no change, of course, on the rates today, as perhaps you might have expected, given everything that was going on. But they did make a few interesting points. Firstly, they've expanded the term funding facility, which is essentially the funding flows that the Reserve Bank feeds in to the banks. And essentially, they've done two things. Firstly, they've extended it out to June 2021. And secondly, they've increased the facility to 200 billion. And they're saying that this is essentially to support more business lending in particular. And, what they're doing is trying to force the banks to effectively lend more. Now, of course, the issue at the moment is not actually lack of supply of credit. The issue at the moment is businesses are very coy about taking it up because they're not comfortable with the nature of the market and the nature of the economy. So in a way, just throwing more money into the system may not have much effect other than increasing the money supply some more. So that was the first point they made. Then they went to the point again, and they've said it before, that the economy is going through a very difficult period, and it's been the biggest contraction since the 1930s. And whilst the downturn may not be as severe as earlier expected, and the recovery is now underway in most of Australia, they said this recovery is, however, going to be uneven and bumpy, and they refer specifically to Victoria. Now, they have effectively gone to the glass half full side of the argument. Again, they keep doing that. But, of course, there's also some contradictory data that we'll touch on shortly. Now, in terms of employment, they said employment increased in June, July. The unemployment and underemployment rate remains very high. And, of course, the official statistics are way lower than the unofficial ones, and probably the righter ones. The official numbers are still saying 10% by the end of 2020 in their mid-range scenario, and 7% 2 years later. But that is the unemployment rate as officially calculated. The true rate is significantly higher. And if you include the underemployed, then we're probably talking more than 1/5 of the workforce being underemployed in some way, which is huge and is going to have a very significant draining effect on the overall economy. And they also said that they won't increase the cash rate until progress is being made towards full employment, and that the RBA remains confident that inflation will be above or within its 2 to 3% target band. So they haven't quite done what the Fed did, which was effectively say they're prepared to allow inflation to run hotter if it can help with full employment. But of course, the bank is worrying about full employment all the time, and all of the language that they have is about jobs, jobs, jobs. Now, what quality of jobs and what the implications of those are, of course, is the interesting and big question. Now, here's a bit of information which is quite useful. The data came out today which showed that the Australian current account is at a record high. So the surplus climbed to 3.7% of GDP, and that's the record right the way back to 1959. Now, of course, what happened is that the COVID pandemic hit imports harder than exports and also crushed returns for international investors. The current account surplus climbed to 17.7 billion, and that's an 8.7 billion improvement on March. And as a share of the economy, the current account surplus represents about 3.7% of GDP. That eclipses the previous record high of 2.3% of GDP back in December 1972, and of course in December 1961. But the point is, according to CBA, it's not going to make a huge amount of difference to the GDP. The GDP, which is going to come out very shortly, is looking like somewhere about 5.2% negative, according to CBA. And they basically say that the fiscal transfer to the household sector, in other words, all the money that's being shelled out, can help for a bit, but for the long-term health of the economy, it's got to be about jobs and full employment. And it's also worth just highlighting that the consumption, which is obviously the household bit, is where a lot of the pressure is. Plus, of course, dwelling investment down, business investment significantly down, public spending up, of course, as you would expect, because basically it's the public sector that's supporting what's going on at the moment. Inventories down, and of course helped by the trade element. So you can see that the trade element is relatively benign in terms of the overall contribution. So the news on the international situation isn't sufficient to in any way negate the prospect of another quarter of negative GDP, which of course signals potentially a recession. Now, the other point it's worth making is this particular slide. This is updated from UBS and they've used the ABS data, just to highlight again that the stimulus cliff remains. So we had more than $100 billion, which is well over 20% of GDP in the third quarter. It's going to drop to about 7.5% of GDP next quarter. And then it's scheduled to drop again in the first quarter 21 and the second quarter 21 almost nothing. Now, of course, the big question is what's going to be the effect of this significant drop here between essentially where we've come from and where we're headed. Bearing in mind, of course, that Victoria is still very much on edge at the moment with regard to its economic performance, even if the virus is now a little more under control. And the fact of the matter is this drop, which you can pretty much see if you look at the latest superannuation withdrawals, they've come down. We know that the legislation was passed today in Parliament to reduce the JobKeeper and JobSeeker as was proposed. And we know that's going to continue. So that's going to be ratcheting down. And my own view is that this is going to create a huge negative drag on the overall economy going forward. And just to re-emphasize that, the latest I misspelt that, my apologies. The latest PMI is still weak again. And in addition, the latest from the ANZ Roy Morgan was that household confidence declined 2.7% after 2 successive weeks of gain. And the weaknesses, they said, were predominantly due to declines outside of Victoria and New South Wales. Now, this is something I'm picking up in my surveys as well. And that is that essentially we are beginning to see evidence of momentum sagging away in other places across Australia as well. And that, of course, is a very significant risk simply because of things like tourism not working and some of the other factors that have been impacted by the slowdowns and shutdowns. So the risk we see ahead is that essentially household confidence remains low. And if household confidence remains low, people are going to spend less. If people spend less, then the GDP will be lower and the economic activity. Now, I've said many times, GDP is a really bad measure of anything anyway, but nevertheless, this confidence number is, I think, quite concerning. And here's the information which Tarek actually put together, avid commentator for those who follow him on Twitter. And it's just highlighting that the property information that's available is getting more and more ragged because more and more price withheld data is coming off the back of Sydney auctions, for example. This is the domain data these put together. And we're seeing that pretty much across the country. So pretty much wherever you look, a lot of transactions are being hidden. And that's because, of course, the prices were lower than the ones that were advertised. And we are seeing significant negative momentum in prices. What that also means is that those withheld prices don't then flow into the index for several months, which means that some of the indices are overstating the current state of property simply because those prices are being withheld. And whilst we can't quantify precisely the degree to which that is true, when you actually start looking at the detail, you can see quite a lot of evidence of sales lower than previous prices. And we did sort of shows on that a little while ago just to emphasize that. And Cookie Boy put some very nice information together to be able to share some of that. We'll do some more of that down the track because it's another example of just trying to bring some relevance and reality to what's going on. But this chart from Tarek I thought was really interesting, so I wanted to share it with you. Now, the other thing to talk about is that the auctions are still relatively slow and the clearance rates are nothing like what Domain and CoreLogic are claiming. I go with the SQM data. This is the latest that came out today. So in Sydney, 51% auction clearance rate, 26% in Melbourne. And Canberra's not too bad at 67%. Hobart, 100% on auction, so that doesn't tell you anything. But Adelaide, relatively slow, and of course Brisbane pretty slow. And it's also worth saying that, of course, not all markets are often driven by auctions. So in Perth, for example, the auctions is much less likely to be used. Although I have spoken to a couple of agents in the week over there, and they said that due to the fact that many agents were under financial pressures because the rate of sales had really slowed, and some are on JobKeeper, they are quite keen to encourage people to go to auction, because if you go to auction, you pay extra fees up front for the auction for services. So that may be one reason why we might see a bit of a spike in auctions over in the West, despite the fact that the overall numbers are still very low. So I think it's important to just understand the reality here. The true story about auctions is not what is reported in the mainstream media. Again, at the weekend, everyone was saying, "Hey, Sydney's back." Not on these numbers. Now, the other thing that came out today was the information from CoreLogic. Now, overall national home prices were down a bit. Again, not surprised really. But they also made the point that nationally, capital city rents have slid a bit more. And since the end of March, capital city dwelling rents are down 1.4% compared with a drop of 2.3% in dwelling values. But if you look carefully, in some markets, there's a considerable drop. For example, there's a significant difference between Sydney and Melbourne, and Hobart recorded a significant drop. In units, for example, Hobart is down 5.1% between March and August, and 3.1% down in houses. And whilst there are some regional more positive moves, they're actually relatively benign. And what that tells you is that the rental sector is still very much under pressure. And we're seeing that in my data too, and we'll talk about rental stress shortly. And the other point from CoreLogic, which they also released today, is that the forward indicator of mortgages remains and continues to be very low, which is more weak lending flow ahead. So not a lot of information there to support anything other than more price slides, in my view. And the other thing, just from the data which came from the credit aggregates, this is from the RBA data yesterday, and all credit is now at an annual growth rate of 2.4%. So you can see it's pretty much down the lowest it's been. You can also see that broad money is running through the roof. So all this stimulus, all this superannuation money, all of the other stuff that's going on has created a huge well of money sloshing around the system, but it's not actually going anywhere productive, and it's not driving credit positively. So that's an interesting observation. We also saw that the savings ratios are likely to be much higher because a lot of people are saving more simply because they are less comfortable about what's going on ahead. Now, the annualized housing credit growth rate is now at 3.1%. So you can see that that's still pretty low. And as I keep saying, it's the rate of change of credit which is really the critical thing to understand home prices. There's nothing here to suggest anything other than that more weakening from credit, despite the Reserve Bank encouraging the banks to lend, despite the fact that rates are really, really low. Overall credit's pretty low. And in that, owner-occupied housing is 5.4%. But remember that this includes all of the rolled up principal and interest loans that have been made, and roughly, well, it depends on how you measure, but 9 or 10% of loans are in that category. So that's one reason why the balances will be higher. Investment lending was down 0.7% on an annualized basis. So no joy there for property investors. And personal credit was also way down. Interestingly, more people are using things like Afterpay and other buy now, pay later facilities, which are not classed as credit products, which are not reported in any of the credit numbers. So in a way, this personal data, credit data, is probably not telling us the full picture with regards to debt. And I see that in my surveys, where a lot of households are actually under the gun on multiple fronts with essentially credit card debt and afterpay bills and other buy now, pay later bills as well. Business was also down, and that's another very worrying factor, that essentially businesses are borrowing less. There was a big splurge, of course, early on. That was to help cash flow and to capture credit limits that people had, but now business lending is down as well. And if you go to the ADIs, the overall amount of lending did rise slightly more again, just a little. You can see that's close to 1.8 trillion now. Within that, though, the share of investment loans fell again. It's now just a little bit above 36% and continues to slide. And that trend has been there for a long time. And the other interesting thing to note is that if you look at the rate of change by category, owner-occupied lending was only growing 0.25%. Investing was minus 0.23%. So total credit growth for ADIs only grew in total 0.08%, and that's including all of those rolled up loans that I mentioned earlier on. So net, not a lot of evidence here for a lot of credit facilities being extended. And then finally, the lender footprint's quite interesting. So it's a chapter of two halves, right? Because you've got Australia and New Zealand banking, ANZ, and Commonwealth Bank, both extending their footprints, and ANZ actually doing quite a lot of investor lending. And Macquarie reducing their investor loan portfolio very slightly. But look over here, National Australia Bank and Westpac both reducing their loan portfolios and both significantly skinnying down their investment portfolios. And I think that's a very significant shift in terms of those two banks over there. So NAB and Westpac and ANZ and CBA. We'll see whose strategy works out later, I guess. And remember that NAB's CEO 2 weeks ago, Ross McEwen, said he felt that there were people who should be selling now because the risks to their financial position would extend if they didn't take action straight away. Now let's go to mortgage stress. So the data, which is to the end of August, stress is now at 40.1. It was 40.2 last month. So essentially no real change. There's a little bit of movement within the parts, as I'll explain in a moment, but I'm still projecting 40.8% by the end of September, and that's partly to do with the runoffs that I showed you earlier on in terms of the government stimulus. But across the states at 40.1, that's more than 1.5 million households in stress. And you can see there that the highest proportion are in Tasmania, 48.8%, then Victoria at 44.2%, and there's 437,000 households there. That's higher than last month. WA at 43.4% with 193,000. Some in the ACT, and in fact the ACT proportion is higher than New South Wales, which is at 37.6%, and that's 424,000 households in stress. And it's also worth highlighting that the risk of default over the next year is highest in New South Wales with 27,000 compared with 25,000 in Victoria, and also 18,000 in Queensland. Queensland's at 36.4%, but that's still 259,000 households. So there isn't a lot of good news here in terms of stress. It's still building, and specifically, if you compare Victoria at 430,000 last month, we've now got another 7,000 households fallen into stress over the month. That rate of change is very concerning in my view. Now, if you look across the segments, which is another way of doing it, and as I explained, that's we slice and dice the data to be able to do that. Young growing families, 73.4%. That includes a lot of first-time buyers. So some of those buyers came into the market relatively quickly, and not that many months ago. Some of them took advantage of these low interest rates and also the incentive schemes that were around, but some of them got into trouble already. Other first-time buyers are actually from earlier 3-4 years ago when the lending stands were even more loose, but 73%. Then we have urban fringe and battling urban and disadvantaged fringe. Those are as you would perhaps expect. But then look at this, exclusive professionals. So this is the top end of the market, 36.3%, 252,000, total in stress, 86,000. and 9,000 risking default. And it's worth highlighting again that the total loss that we're looking at in that segment is higher than any other segment. And that's because those tend to get bigger loans. Those households tend to have multiple mortgages and multiple properties. And as a result of that, up till this point, banks have been very willing to lend to them. But of course, some of these are now finding their jobs are disappearing. So finance jobs and consulting jobs and other sectors too. So we're seeing this structural employment now starting to hit the top end of the market, unfortunately. And then we've got some of the recent migrants who are on the list there as well. And then it spreads pretty much along the segments. But that's the way that it's broken down by segments. And then if you just look at some of the postcode with the highest level of mortgage stress this time around is Ballarat 3350 with 7,462 in stress. Then we go over to WA, there 6030 with 6,800. Then Hoppers Crossing, that's in Victoria, of course, and a number of Victorian postcodes like 3029, 3064, 3178 are all registering. And then we go to Queensland, to Mackay, back to New South Wales, 2567, which includes Harrington Park and places like that. And then Mount Druitt, Minchinbury, 2770, back to Victoria, to Cranbourne, 3977, and then back up to Queensland again. And there's also South Australia coming into focus, and then Launceston as well, 7250. And you can see that this is actually a really interesting mix, because you've got a mix like Ipswich, for example, a bit further down the list. It's quite different from some of the other places on the outskirts of towns. So we've got numbers of cities, some of the regional centres, and some of the urban centres all being caught by this. And this, of course, is going to put a dampener on prices, house prices, significantly. It's one of the factors I use when I measure house price falls. Now, here's just a way of showing it. And what I've done here is just to map the Sydney situation. And I can just drill in a little bit and just show you a little bit here. You can see there that some areas of Western Sydney are actually significantly impacted. So sort of the reddy colours are the most significantly hit ones. Less so in and around the harbour. But look, there are a few significant areas close in that are also registering difficulty now. And I think we're going to see a little bit more of that ahead, simply because there are some younger households and some more affluent households being hit there. So that's Sydney. Let's go there. If I then go to the next one, we can do the same for the ACT. And once again, it's a bit of a sort of a mixture of different colours, but essentially the yellows and then the reds are the most concerning. So there's a couple of postcodes I'm watching very closely now in the ACT, 2902 and 2900, sort of south towards the Victorian border, I guess, down there somewhere. But that's quite a significant development, and we've started to see that bubble up over the last little while. And here is Melbourne, and whoops, let's go there. Here's Melbourne, and again, Melbourne is showing some signs. So there's a really interesting pattern over here. If you go over to the eastern side of Melbourne, beyond the Dandenongs around there. So postcodes 3808, 3160, 3159, 3802, 3804, 3806. There's a really big splodge there. Up towards the Yarra Ranges, and then if you go up north and north east, again, more painful signs of significant pockets of stress. And of course, the virus has not helped, because it means that many businesses are still off, work has really dried up, and unemployment is rising. So that's a very significant factor in Melbourne. And we're going to see some more of that, I think, ahead as well, because it's going to take some time. If I go to Hobart, again, we are seeing pockets of stress now, so that nasty red-orangey colour. In and around the centre of Hobart, it's quite significant. And, you know, the thing that people are surprised about is Hobart, but of course a lot of Hobart's income is actually from tourism, and tourism is still very much turned off at the moment. Many small businesses are struggling, and so we're beginning to see some of the impacts of that on what's going on there. And if I go to Adelaide, you can see again the same sort of story, pockets where there are pressures and problems, some close in, but quite often a bit further out. And, you know, we're seeing the colours begin to sort of move more and more into the darker, more risky areas. And I'm afraid that that's something which we're going to see, I think, continuing. And we can go across to Perth. And the story is, you know, consistent with what we've seen before, but more so, as it were, because what we're seeing is around Perth itself, and, you know, the areas in Perth is not too bad, but if you go north or south, you start seeing issues in one or two of the postcodes towards the coast or further north, like 6015 and 6017 and 6029, have significant pressures. And if you go south and you go a bit further south than on the map here, you can begin to see some pressures down there as well. Mandurah, of course, is still very much registering as a very significant risk area, even now. And somebody's kindly sent me a clipping from a local paper today that highlighted more social issues and more issues with property sales over in Mandurah even now. So I keep saying that Mandurah has the potential to be the archetypal postcode that we're going to see perhaps develop elsewhere, where effectively unemployment continues to go the wrong way. House prices continue to fall. Mandurah is down 38% from peak. We get social consequences and problems off the back of it too. So unfortunately, that is, I think, possibly what we're going to see more of. This is just up to Darwin, because people say, well, you never talk about Darwin. So here you go, there's Darwin. Not much to say, really. The overall pressure on stress is quite a lot lower. But I also should warn you that the Darwin data is much more fragile because the sampling is very low, because it's just a much smaller population. So I don't hold too much court by this. But nevertheless, there are pockets there. And if I then go to my last one, just over to Brisbane, and I kept Brisbane till last because I wanted just to highlight the fact that if I go in a bit, you can see that around Brisbane itself there are a few patterns now beginning to emerge. We've obviously got the issues over in the west. I mentioned Ipswich earlier on and places like that, and if you go down towards Logan and that down there, again, there are pressures there. So again, hotspots. What I'm seeing in Queensland is the pressures are different, because whilst the jobs situation looks a little better than some other places across the country, small businesses are struggling, and a lot of tourism, of course, doesn't really happen at the moment. So significant issues there. And I am watching the traffic around Ipswich. I think that's going to be a particularly concerning area. So there you go. That's the overall situation with mortgage stress. Let me just quickly then go to rental stress. So we've got 1.7 million households, or 41.1% of those renting, in rental stress, with Tasmania at 53.7%, Victoria at 43.8%, 41.3% in ACT, WA, New South Wales. So rental stress is getting worse, and there was a report today from Anglicare highlighting the issues around lack of affordable rental accommodation. I agree with that from my data proving that. You can look by segment. So younger families, 74.3% in stress of those renting, 127,000. But we've also got some other categories too, and even stable mature families and suburban mainstream families, a relatively smaller proportion, but of a large number. So this rental stress is very much not just young people, and it's not just urban fringe people or the battlers. It's actually hitting many different segments, and this is because of the fact that rental stress is a combination of factors, including loss of job, loss of income. And here's just a few examples. The most stress from a rental stress perspective is Jervis Bay, 2540, followed by Campbelltown, 2560, and you can see there at 9,600, 9,300 households, 73% and 77%. And then we go to Liverpool, 2170, with 54%, and Mount Druitt, so that you can see a lot of this is New South Wales to start with. And then we go down to Hoppers Crossing, again Victoria, as perhaps you might expect. Bundaberg, Wollongong, close to home for me, was also on the list. Bondi, Toowoomba, Blacktown, Surrey Hills, Darlinghurst, South Yarra, and so it goes on. So a lot of rental stress pressure, but again, not uniformly spread and driven by a number of different factors. Then if we just drop into investor stress, so this is looking the other way around. So this is basically people living in a particular postcode with property investment. And overall, we have 25.4% of property investors who are actually stressed. Now, they can be stressed because they haven't been able to rent their property out, it's vacant. Stressed because they've got negative cash flow. In other words, the rents aren't covering the costs of the property. Stressed because they're trying to sell the property and aren't able to. So those are some of the factors we use. And that's essentially 826,000 stressed investors out of 2.8 million rental property owners. And together they own 3.2 million properties for rent. And you can see how it's distributed. In fact, the highest proportion of stressed investors across the country is in New South Wales at 33.8%, and that means that there are more than 316,000 stressed investors. Whereas if you compare that to the ACT, a very small number, 20,000, but 33.1%, Victoria at 24.9%, 208,000. And these stressed investors are very strongly aligned with an intention to sell their property. So we're seeing quite a lot of property investors now saying, I can't see any capital appreciation, so it's now time possibly to sell. So that's one of the reasons why I'm talking about the fact there may be more selling. And just by segment, again, young affluents right at the top now, 55.3%. And the thing about young affluents is they're often a little bit naive about their property investment strategy, and so they're often geared up and leveraged, and that's perhaps one of the reasons. And they've bought quite recently, and now prices are falling. Then exclusive professionals. So the more affluent household groups, young affluent exclusive professionals, are in fact right at the top of the list. And 48% of exclusive professionals are actually now registering stress. And that's because they often have complex portfolios of investment properties, all of which cross-leveraged. And whilst on the way up it works really well, on the way down it doesn't. And so they're considering maybe being forced to sell. So that's a little bit about property investors. We'll continue to track that, of course, because it's pretty important to understand where that is. I may well produce some heat maps in due course. I haven't done that so far, but I may well do that later, just to show that there is an interesting difference of correlation between the distribution of property investors and the other segments that we've spoken about tonight. The point, though, of course, is that investors live in a particular postcode. It doesn't mean they invest in that postcode. They may have properties pretty much anywhere. So that's why we've got to be a little bit careful about the data. And just in terms of the top postcodes, Melbourne 3000 still is right at the top with 76% of those living there as stressed investors. And that is a big, big number of 4,000. If you go then down to St Kilda, that's the next one, Mandurah over in Western Australia. Surprised? No surprise to see that on the list, I'm afraid, at 32%. 81% of investors over in Surrey Hills and Darlinghurst. So that's a real hot spot, even if the numbers are a little bit down. And then you can go and look at places like Wentworthville, Westmead and Bundaberg, South Yarra, and low North Shore like Crow's Nest and St Leonard's around there, and then Rush, Craters Bay and Woolloomooloo. So wherever you look, Wollongong's on the list again, unfortunately, as well. So wherever you look, you see these pain points, and this all translates then to significant pressures later. Now, just in terms of our scenarios, I've explained before, the scenarios we use are designed to just talk about the different levers and things that have changed. And in fact, I have made no changes to the scenarios from last month, simply because everything is moving in line with my scenarios. Nothing has really changed. The data is exactly as I expected it would to be. So I have not needed to change the underlying scenarios. And for my individual postcode scenarios, I knock off the least two, in other words, the bottom and the top, and go with the three main scenarios, which is basically the best case, the longer term crunch, where I think a lot of the weight of evidence looks like it will be somewhere between a fall of 15 to 30% down, and the second wave, which is still a risk there. So that's the scenarios, and we're not going to change them this month. Now, I want to introduce you next to my new tool, and there's a little bit of a story to tell here, because as you know, I've had this ability to be able to actually drill into a postcode and been using on the fly tools, but I've been working with a technology partner who's really approached me, somebody who's been watching the show and runs a business and is willing to help, and we now have an alpha version of my postcode tool. And I'll just put an example in. Let's go for Melbourne 3000, just because we've just spoken about it. And this is essentially what you now get. So basically what you get is now a little map to show you where we're talking about, which is pretty neat. A description based on my particular models. So, lots of suburbs in one postcode. The number of households, the proportion borrowing, the proportion renting, the number of properties for rent, the number of rental property owners, which is the other investor angle, and then the percentage overall in financial stress. So that's an overall measure for that particular postcode. So that gives you, if you like, a top-level view. And then you can drill down into the mild mortgage stress, severe mortgage stress, and therefore the overall level of mortgage stress, the risk of default, the percentage of default over the next 12 months, and then from the renters, how many of the renters are actually stressed and what that percentage is, and then the investors and what percentage is stressed. And you also get this as well, which is essentially the scenarios for each postcode. The middle scenario is my base case per that other chart, and then you've got a high and the low case. And we've got a few things to tidy up yet. For example, we've got very, very long numbers there because we haven't actually rounded it down, but we will do that. But this will be available not immediately, but quite soon for any postcode in the country. And that means that it will be feasible for anybody who wants to track the situation with regard to stress and with regard to our scenarios on a monthly ongoing basis. Now, of course, a number of people are subscribing via Patreon to get the total data set, and that's a different proposition because you get every bit of information. This is just for a particular postcode, but that's the tool. And in fact, later on, as we progress through the discussion, if people want me to answer questions about a particular postcode, this is the tool I'll be working with. I'll talk more about the technology partner that we're working with and some of the other plans that we've got to take this further and add other functionality into the online facilities that we'll have available. Because what we're trying to do here is make it easier for people to get more informed about what's going on. So that's the tool, which I'm very pleased to be able to share with you. And there will be more information quite soon about that and where we head next. Okay, and with that, I'm pretty much done. So I'm going to come back and start looking at the questions. I do have a couple of questions loaded, but I'll just have a look over there and look at the chat, see what's going on, and have a look and see what's asking. So Javier's asked, the Aussie dollar sitting on the edge of a cliff will reach 75 cents this month, possibly up to 76. Now, is it going to be dumped? He's saying he's buying US dollars now. Interesting question, right? Because, of course, the Fed basically declared rates will be lower for longer in the US. And they also said they wouldn't lift rates until such time as full employment is achieved, even if inflation is actually driven higher. And as a result of that, bonds essentially said, well, the rates on bonds will be longer for long, and therefore yield went up. And we saw that pretty much immediately. And then the Aussie dollar moved up, which, by the way, means we could be deflating rather than inflating here, because effectively we'll be importing deflation rather than inflation, which is perhaps what the Reserve Bank might want. So it'd be interesting to know whether the Reserve Bank has enough ammunition to be able to keep the dollar down or whether it will go up 75 plus. And I saw in the chat earlier on some people saying that, well, it may well collapse later. The question is, of course, it's all about international confidence. And at the moment, on an international basis, our limited GDP falls are nothing compared with 20% from the UK, and Canada was quite high as well, and the US, of course, was very high. So at the moment, we're actually doing quite a lot better than many other countries, and so that may support the Aussie dollar for longer, but it's going to create significant problems for us locally, because what it's going to do is essentially reduce the value of our earnings overseas as it comes back to Australia, increase pressure on businesses here, and probably will put more businesses off work and out of line than previously. So the high dollar is a significant risk, I think. All right, now let's see what else I've got in the chat. Yeah, young doctor GP says, I'm a young doctor in Sydney and I can't even afford a simple family home. How ridiculous. Do you think it is that young people can't afford anything without wealthy parents? Yeah, it is a huge issue. And look, the fact of the matter is that housing affordability is rubbish. It's been rubbish for a long time, but it's been a policy driven by the government and by the Reserve Bank. Remember that what happened there was that after the mining boom, after the global financial crisis, we had an issue. And as a result of that, basically house prices were allowed to run up, lending standards were allowed to erode, bigger loans drove bigger prices, etc. And we've still got that process running. We've some of the highest debt in the ratios in the world. And on an ongoing basis, property is 40% overvalued compared with long-term trends. So that's why I keep coming back to there's a risk that prices will fall, and it could well come back to 40%, and that would then you back to long-term norms. So it's not like that would be cheap, it would just be normal. So the way that housing affordability is being addressed at the moment is that the banks are still offering even bigger loans because the interest rates are lower. But that's a stupid strategy, and it's going to just create a bigger problem, plus offering incentives. But every time incentives are offered, it just lifts the price of the asset. For example, in Western Australia, with all the land price, within the land packages, home and land packages, $55,000 is available thanks to state and fed. Put that in there, and you'll see that pretty much every home and land package has gone up by the same amount. So effectively, people are paying more. So it's a net sum game, zero-sum game. And that's my problem. So we have to address housing affordability differently rather than just saying there's nothing to see here. And yet, even the Reserve Bank is still saying we don't have a problem. There was a paper published a couple of weeks ago, which was a complete joke, frankly. They used very old data. They basically argued that even if prices dropped 40%, there's nothing to see here. But the real discussion should be about housing affordability, because the housing ratios to income are just ridiculous. So even in Sydney now, there are people getting 6, 7, 8 times income to get a mortgage. That's ridiculous. That should not be possible, and it should not be allowed to continue. But unfortunately, the policy settings are wrong. So I agree with you. It's nuts. And by the way, affordability in regional areas is not much better because incomes are lower as well. So wherever you look, it's a problem. Edge says, is the new tool going to be free? We're working on a few different formulations. We'll probably have a version which will be free, and we'll have an enhanced version of the tool which will be available for some sort of subscription basis or something. There's a lot of work, of course, involved, and some technology that's required to make it all work. So that'll be the idea. But I can absolutely assure you that there will be some information which will be freely available, and which will be always freely available for anybody who wants it, because I am fundamentally more interested in helping people make better decisions than monetizing the data that we've got. So that's sort of my balance. But I have to recognize that we will need to be able to cover some of the costs of the engineering that we've spent time on, and the development centers that are working on this. So all of those things come into play. So, but the answer is there'll be some which will be free. There'll be others, probably more sophisticated, which will be available on some sort of subscription basis. What else have we got? Gold, silver, cryptos says the whole system is completely unsustainable. What about that mum that owns 20 properties How's that possible? Yeah, well, there are so many people with leveraged portfolios, and they've been to these seminars and they've spent a day or two being completely indoctrinated by people who should know better. And I've actually heard some of these firsthand, and they are ridiculous and stupid, but people actually are still taken in. And the fact is that in this current market, with prices definitely on the way down, not on the way up, and with the public reporting of the information much delayed, people are making decisions which they will regret later, I think. One of the reasons why I'm trying to share my data and trying to sort of talk about not just the current situation, but over the next 2 or 3 years. But people are still there, and the banks are still willing to lend, and the government is still willing to provide more incentives to try and get more people to go and buy. First-time buyers, great opportunity, great time to buy, as Michael Zucker said again the other day. The government is committed to helping people to afford their first home. No, the government is committed to allowing funds to flow to the construction sector, and the first-time buyers are the cannon fodder. So that's the way I see it. So unless we can get a different policy and a different way of thinking, we're not going to be able to solve the housing affordability issue. And the other factor to make, and I just want to come back to this because it's so critical, is that where banks are just lending forever more housing, they're not lending to businesses. They're not lending to productive, value-creating businesses. And many businesses that I survey are struggling at the moment. And that's partly because of the virus, but it's also partly because of the lack of funding and the lack of availability of support. If the banks were required to have a more level playing field between business investment compared with housing mortgage investment, then we'd get much better bang for our buck. And you may know that Robbie Barwick and I have been talking about the creation of a national bank, effectively a new investment agency that can invest in productive businesses to basically kickstart the economy that we need to have firing. Because it looks to me as though the commercial banks are just only interested in ever more mortgages. That's all they seem to know. But as I say, what they're doing is sucking all that capital out. And the Reserve Bank just giving them more money, that's just going to make them want to lend ever more mortgages. And so I will expect mortgage rates to continue to be very low for a long period of time. In fact, somebody today sent me a mortgage rate of 1.9 something as ridiculously low rate. But it doesn't help. It doesn't solve the problem. So unfortunately, we need different policy settings. Jeffrey says, thanks for your content. Is it an impossible dream to consider buying a small house in Victoria next year as a first-time buyer based on average income? It's going to be very tough, Jeffrey, but prices will definitely begin to come down. And the fact of the matter is that there will be more affordable property, but without the change of policies, and frankly, without a different philosophical approach from government, it's going to be very tough to get back to affordability. And my own view is that both sides of government, those in power and those in opposition, both are equally culpable for this. It is rubbish, frankly. It is rubbish what's been done. So my own view is it should be definitely changed. Now, what else have we got? So I'm just listening to my wife who's taking the two dogs. We've just had two new dogs, so this is a big aside, but we've just had two new dogs, two Calpis, who those are effectively sort of runny dogs that herd sheep a lot. So we just had these two dogs, and they are wearing us all out because they keep needing walks. So I've been for about 4 walks with them today, and now my wife is taking them out for yet another one. It's quite hilarious, really. Never seen dogs like it before, but it's great fun, but very different from our previous ones. And yes, so if I look a little worn tonight, it's because of the dogs. What else have we got? Future inflation, Michael asks, what do you think about future inflation versus current low home interest rates? Do you expect future inflation to be high enough to warrant borrowing now while rates are so low? Well, there's a really big debate about inflation, deflation, right? And I made a show with John Adams, posted it earlier on today. And the bottom line is this: it's not completely clear which way the story will go with the two outcomes. I'm still of the view that we could have a deflationary future where effectively we have more negative income, we have more pressure on households, we have more unemployment, and all the attempts from central banks to throw more money into the system doesn't work. And if that happens, we end up essentially in a very deflationary environment. The other side of the coin is all the money printing that's there could flow in to financial assets and beyond and inflate things. And if the CPI is a lot higher, you could have a sort of stagflation where you have high unemployment and inflation as well. Now, both those scenarios, in my mind, are live. I'm not totally convinced I know which way it's going to jump at the moment. Some are calling it one way, some are calling it the other way. Harry Dent is saying there's going to be a big crunch and a crash and everything's going to get devalued. It's deflationary. We've got people like John Adams and other people saying, no, it's all going to be inflationary. I'm sitting slightly on the fence at the moment because I think it's too early. So it's difficult to say. But what I can say is without significant policy change, nothing is going to significantly shift the dial from where we are. We're still going to have very high house prices. We're going to have very high debt. We're going to have very flat revenue and income growth. People are going to find it harder and harder to be able to make ends meet because effectively the employment rate will not be where we're used to it. There'll be a lot of people who are unemployed and underemployed. And we also know that the cost of living will continue to rise. All of these factors are pretty much baked in. It's just a relativity in terms of where it all flows to. So it's pretty concerning in my view. And unfortunately, those in charge seem rather willing to go back to the old ways of thinking. Frydenberg a few weeks ago referred to Maggie Thatcher as an ideological driver in some of his thinking. I think that was a mistake, and I think he's probably backed from that now. We need a different way of thinking. We need a different set of policies. And part of those policies, as I mentioned earlier on, is to drive momentum into the business sector here in Australia to create jobs and to create value, not just to inflate home prices, but that requires the banks to do things differently. So we'll see how it all plays out, eh? Right, what else have we got? Is Australia still on track to be back in the black? Not for a long time. The whole idea of not being in debt is out the window at the moment. Of course, the MMTs will say, well, that's not a problem. You can borrow for as long as you want. And, if we are creating growth, then that's fine. Of course, the thing about MMT only works if you can actually create more growth and you create more momentum. If you end up with more debt but no growth, then it doesn't work. And that's the risk that I see. We're going to potentially borrow for the wrong reasons. We're going to borrow to put money in the wrong places. We're going to back in large construction sector and that sort of thing rather than actually what we should be doing. So the risk is we end up with high levels of debt, no real growth, and no significant strategic change going forward. That's a significant risk in my view. Okay, what else have we got? Let me just go up the list a bit. There's a lot of different questions there. Okay, now here's an interesting one. Edita says, many granular expense-related questions when applying a credit card. Any similar news when getting a mortgage? Oh, yes, they're asking a lot more questions. Some are asking 15 categories of costs on a mortgage application now. And they're still applying more granular analysis, but basically they've been given a free pass because ASIC didn't go ahead with the Westpac case. That's the one that was appealed. And in fact, the head of ASIC came out the other day, said, world's changed, we're not going to pursue that anymore. In other words, responsible lending is off the agenda. The banks will back to their old habits again, and we'll, I think, see less questions being asked about the mortgage. I think we will see more bigger loans being written and more people getting into ever more debt. Unfortunately, of course, at a time when unemployment remains high, when incomes are completely stuck, and when potentially people will be over their heads. My worry is that the regulators, that's the Reserve Bank, APRA, ASIC and the Treasury, they sit around the table in the Council of Financial Regulators, they are effectively all on the same page saying debt is the way to get us out of this hole, get people to borrow more. My worry is that that is completely a silly strategy because the debt is already unserviceable. Mortgage stress is already very high. I've shown you that tonight. As a result of that, we're just building a bigger hole for ourselves later. And what is interesting is I've had a chance to speak to quite a few people through my one-on-one series where I talk to them about a particular postcode and we discuss how they're thinking about it. And it's quite interesting that people are getting much smarter about the decisions they're wanting to take and much less willing to commit themselves than previously. And that's good. Now, maybe it's just the people who watch this channel. And if I can take some credit for that, well, that's probably good. But many other people, I think, are still being blindsided by the mainstream media, by all the spin pieces that are being done to try and actually say it's a great time to buy. First-time buyers never had it better. Here's somebody else who's built a portfolio. I get so cross. Remember, prices are not necessarily going to go up for a long time. Remember that after the global financial crisis, the prices went down in Europe and in America for 3 to 4 to 5 years. The worst of the defaults didn't happen until 3 to 4 years after the financial crisis hit. So I keep saying we're only in the foothills here. Unemployment's going to rise further. The Reserve Bank pretty much has committed to that and said it's going to happen. We already have people who are up to their eyeballs in debt. And so, unfortunately, this is going to be a very long, slow grind. That's why my own belief is that prices will continue to be down for some time. And that's why those profiles that I showed you earlier along are quite significant, I think. What else have we got? In question here about a lot of us are curious about the impact of inflation on house prices. Any thoughts? Okay, it's an interesting one, right? Because effectively house prices, there's two ways of calculating house prices. There's a market discovery method, which basically is what are people prepared to pay, and on that basis, prices are going down because the average settlement gap between asking price and settlement price is now dropping. In other words, people are paying less. So that could actually be one of the downward forces. However, the construction costs for new properties are rising. That's partly because the material costs are actually more complicated than they used to be. Some of the supply chains have been disrupted because of COVID. And of course, property investors and developers are looking to make a return. And in some cases, the best way to do that is to put the prices up. So there's going to be some interesting tussles. My own view is it's unlikely that we're going to see much house price inflation anytime soon. And it's more like we'll see prices fall, as my model indicates. Now this is an interesting one. I'm looking at the bottom end of the market around Bundaberg, Gladstone and Rockhampton, but I'm worried that there'll be a greater demand for the cheaper real estate as the recession progresses there. Well, there's a few things going on there. Of course, prices up in those areas have not done a lot, and they've come down quite a long way from where they were previously. Probably will continue to do that. There will be people looking for cheaper properties away from the urban centres, and one of the things that's happening is there's more interest now in regional centres and beyond, because of course if you can work remotely, as people begin to realise they can, then you don't need to be so close to the centres of town. Now I'm out of town here. I moved out of Sydney some time ago, and I love it being out of town, but I don't necessarily want too many other people coming down too, because it's already quite crowded down here. At the weekend, you can't move. There's too many cars going through. And that's the other problem, right? So if you start sort of spreading the population base further around, you just spread the infrastructure risk issue as well. But nevertheless, you could well be in a situation where there will be other purchasers who are competing. And we've already seen stories locally in my immediate area where, in fact, prices have still been supported to some extent by people buying who are used to Sydney prices and coming out further. So that's another factor to bear in mind. I tend to agree that that is a risk. Okay, so here's one. Postcode 2620. Where would it be in 12 months? Well, let's have a look. I'll get the old tool up and see whether we can make it work. this is all very experimental, so we'll have a go. 2620. Okay, it seems to have come up. Let me just switch it across so you can see it. Okay. 2620, so there you go. So what we're saying is over the next 12 months, we're looking at a best case of around 8% down over the next year, and maybe over 2 years, 14%, and over 3 years, around 18%. That's the mid case. So if you think that prices are going, if you think that the economy is going to recover more quickly, then we're looking at a 3.2 down to 6.9, and then slightly higher. So that's the sort of the trajectory there. And interestingly, in that particular postcode, mortgage stress is relatively low, investor stress is relatively low, and overall financial stress measures are also relatively low. So you would think that that particular postcode is relatively insulated from some of the immediate pressures, not least, of course, because the federal government's there, and therefore government jobs pay well and continue to pay even when the economy looks a bit sicker elsewhere. So that would be my view, and that's one of the reasons why the price falls are less severe in some of those areas compared with others. See, the tool works. Phew, that's good. Okay, New South Wales 2440. Let's put that one in and see what we get. If the whole thing crashes, then it's my problem, but I think it should be all right. There we go, 240. You can see it's a little bit more sophisticated than my particular way I was using it previously, where I had to put the query in and keep getting it wrong. Okay, here we go, New South Wales 2440. So, this is quite a lot of different suburbs, right? You can see where it is. It's sort of south of Coffs Harbour there, between Coffs Harbour and Port Macquarie on the coast. And it goes inland a fair way as well, places like Coomera, for example. Number of households, 9,600. Borrowing, 2,992. Renting, 4,132. 3,151 properties for rent. And the number of rental property owners, 3,200. In stress, 43%. So that's sort of middle of the road, slightly higher than some, but not, as adverse as some. Very low levels of mortgage stress, only 2%. Significant rental stress, and we see that in a number of these coastal areas up the coast. Rental stress is quite high, and that's because there's a lot of part-time work and a lot of people who are essentially reliant on things like tourism and those things, and so many of them are out of work or working less hours. They're in rented accommodation and they're struggling with their rents. And by the way, quite a few of them are confused as to whether their rental holidays, if they've got them, are forgiving rent or whether it's just postponing rent. And quite often people are not clear, and I think that's an important risk issue that people haven't woken up to yet. 58%, so that's high, and investors not too bad at all. So the midpoint is a 10% fall over the next 12 months on average, and then another 6% in the second year, and then 20% over 3 years. Now I should explain, this is the total for the postcode. Generally, if you're thinking of houses, then the falls will be less severe. Units tend to be closer to this or slightly higher than this, because this is an average of houses and units, but it gives you a sort of trajectory. So that's still looking like a fall over the next couple of years. Okay, another one. Andrew asks for 2779. I'll try and do this on screen so you can see how easy it is. 2779. Look up. Quite nicely animated as well. I quite like the way that works. Okay, this is Hazelbrook, and there we've got just 2,000 households. Half of them are borrowing, 535 are renting, 406 properties for rent, and 583 rental property owners. 42% in financial stress, but look at this, 58% in mild mortgage stress. So that's a very high number. Anything above 35 I get worried about. Rental stress, not too bad. Investor stress, not too bad. So the real question here is those people with mortgages and whether they're going to be in a position to be able to repay those mortgages or not. And the interesting observation there is that we're predicting a 9% fall over the next 12 months, followed by a 15% in the second year and slightly more in the third year. So the total fall midpoint is 19%. somebody's asked there, Trump versus Biden. Don't get me started on Trump versus Biden. What's the impact of the stock and housing market? Okay, so the first question is, who's likely to win? I think it's line ball, but my own view is Trump looks as though he's got the measure of Biden. And if you look at what he said through his campaign last week, I think his team has worked out where to sort of push the pressures. Biden, of course, is basically fighting with a cardboard cutout of whatever Trump says. He's doing the opposite, but he doesn't really have a huge amount of policy. He's also playing the same cards as Obama did. Not sure he'll be successful. So my fear is, and I do say, my fear, because I think it's be wrong for the US and wrong for the world, but it could well be that Trump gets back. If that's the case, the stock markets will love it, because essentially the thing will continue. Basically, we'll see ever more proactive strategies to try and support the economy, i.e. stock market, i.e. the big end of town. Now, if Biden gets in, we will see some changes. There will be some sort of approach in terms of trying to rebalance the economy, and the markets probably won't like that much. So my view is the stock markets will probably be stronger under Trump. The international relationships will be weaker under Trump. It'll be an America First strategy. And my worry is that we will end up with an even more dysfunctional US, which of course doesn't bode well for us, because we are caught in the crosshairs between China and the US. And of course, at the moment, every time we sort of wiggle towards China, we get shouted at by the US, and every time we wiggle towards the US, we get shouted at by China. Not a very comfortable place, particularly when China's our major trading partner, of course. Okay. I live in the Shire as well. Let's aim at postcode 2230. Somebody says there. Who's there? PZPZ. Okay, we can do that one. 2230. Bung it in. Cronulla and surrounds. Okay. Just display it back. There you go. Okay, so Bardina, Cronulla, 13,500 households, 4,600 borrowing, 6,200 renting, 4,659 properties for rent. Number of rental property owners, 4,157, 51% in financial stress, 30% in mortgage stress, 53% in rental stress, so rental stress is quite high, and 59% of investors are feeling the pressure. So investors in that particular postcode are beginning to can be concerned. Remember, they may not have investment property in the postcode, but that's where they live. So that will be a significant downward pressure. And look, anything above 50 in financial stress, that's quite a warning sign. So that's one of the reasons why the 11% drop over 12 months is my midpoint, followed by another 7%, and then followed by another 4 or 5%. And of course, if the worst case comes true, then we're looking at a total fall of more than 30% on average in that particular postcode. But, as I explained earlier, that's based on my worst case scenario. The mid case is probably a more accurate expectation. And if you're really positive, then it might be the upper case. So there you go. I hope that helped. And I should say, by the way, that we're still developing these tools, so give me some feedback if there are things you'd like to see in terms of other tools that we could perhaps make available. I've got a few suggestions from a number of people, but we're very open to it. We're going to try and make these as flexible and as agile and as useful as we can, bearing in mind that our main task is to help educate and help arm people with better information to make better decisions. That's what it's all about. BB says scenarios for 3029 and 3750. We're going to do one at a time now. That's one of the weaknesses of this particular approach, is that you can only put one at a time. But, that's just the way to do it, simply because if you try and put multiple ones in, you can't actually really get to... I've lost it, sorry. There it is, 3029. One of the things about this chat... is that 3029? Is that right? Yeah. One of the things about this chat is it jumps up and down occasionally. I haven't figured out why it does it, but it does. Okay, this is Hoppers Crossing. 30,000, of which 18,000 are borrowing, 11,000 are renting, 8,500 properties are rent, and 9,000 rental property owners. 50% in financial stress, 34% in mortgage stress, 66% in rental stress, and 22% in investor stress. So 34% in mortgage stress, but of course the big number because it's a very big postcode, so that's a significant dampening factor. And the rental stress is very significant too, so quite a few people are struggling. And as a result of that, our midpoint is looking at a fall of 12% in the first year, down to about 23% in the second year, and down to around 26% in the third year. That's the midpoint for that particular postcode. And the other one was 2750. You know what I should have done? Push that button so you can see it. My apologies. There you go. So that's the one we've just done. That's at 3029 with 30,000 households with mortgage stress at 34%, rental stress at 66%, and investor stress at 22%, and falls of 17% in the first 12 months. 17%, I misread that, and 23%, 24 months, and 26% over 3 years. So it's a significant fall, and it's driven by these mortgage and investor stress numbers particularly. So let me now go to 3750. There you go, 3750. So that is Woolwich, just a small number, 3,000 households. Financial stress 91%, with 71% in mortgage stress, and renter stress extremely high. It's quite a small number, but that's a significant number. So we're saying there's a lot of rental stress there, 23% of investors. So it's really a owner-occupied renter stress issue, and that's why we're looking at a fall of 21% over the next 12 months, followed by a fall to 27% in 2 years and 30% in 3 years. So you can see that's a significant area where there's a lot of potential risk. And there'll be a lot of new properties there. There'll be a lot of people who've bought relatively recently and are now finding their incomes are being crushed. Okay, how are we doing? 918. Yeah. What are your thoughts? This is from Young Sydney GP. What are your thoughts on rental prices? Are they within historical norms or also inflated? Well, they were, but they're dropping back. So I showed you the data earlier on tonight with the Hobart prices. Rents are down again. Rentals are still quite high relative to incomes. So they haven't corrected, but they are beginning to move in that direction, because rents tend to follow not home prices, but incomes. And incomes for many people have not moved at all or have reduced in real terms in the last few years. So it tends to be the case that the rentals follow income, and as income is getting crushed, so rentals come down. Of course, that's one reason why property investors are now really feeling it. So as well as the fact that there's no capital gain because there's no growth in property, the rental returns are being squeezed, and the negative gearing power is reduced because the interest rates are so low. So many people are struggling to make anything out of property investing now. One of the reasons why there are more property investors in my surveys who are saying, we're thinking of selling. Okay, what else have we got? Let me just go through this. This here. So Kat's asked for Footscray 3011. Can do that. So this is more productive use of time, isn't it, with the new tool? So the tool is proving itself to be very productive. I'm very impressed. Okay, as long as I can put the right number in. 10,000 households, of which 2,900 are borrowing, and 6,000 are renting, and in financial stress, 37%. Mortgage stress only 10%, that's pretty low. Rental stress at 37%, and investor stress at 39%. So middle of the road. But because it's Victoria, because it's COVID related, it's looking like a 15% drop in the first year, down to 21% in year 2, and down 24% from current position year 3. So that's the Victorian 3010. And TBA asks for, let's try that differently, shall we? Let's go there. Okay. TBA asks for 4650. There we go. Queensland, large area, inner regional Australia. Don't think I recognise many of those suburbs, so I'll just read it through. 15,500, of which 4,900 are borrowing, 6,000 are renting, 4,900 rental properties, 20% in financial stress. So it's quite often the case in Queensland, in some areas, the stress levels are lower. Mortgage stress is very low. Rental stress only 28%. Investor stress at 16%. So, and this is a good example, right? So in our mid case, we're saying there'll be a small fall of 3% in the first 12 months, a bit of a bigger fall down to 10% in the second year, and down to 16% in the third year. So that's the way that it works. But if for a positive case, there is actually potential upside, slight amount of upside in property in that postcode over the next 12 months. 2779, have I done that one? Whoops, let's try and make this work. There you go. Did I do that one, Hazelbrook? Not sure I did. So you asked for that one. So that's Hazelbrook, 2,000 borrowers. Sorry, 2,000 households, 1,000 borrowing. 58% in mortgage stress, 20% in rental stress, 14% in investor stress, and the falls looking like 9%, 15%, and 19% over 3 years. What else have we got? 3046 Glenroy. I'm going to run out of time, I'm afraid. So I'll always make this point. If you don't get yours on the show tonight, you can always send me an email via the DFA blog, and I'll send you the chart back over the next few days. This is 3046, 13,900 households, 4,900 borrowing, 6,000 renting, 47% in financial stress, 68% in mortgage stress, so that's significant, 37% in rental stress, 26% in investor stress. So this rental mortgage stress is significant, and we're looking at a drop of 17% over the next 12 months in our mid case, followed by 23% in year 2 and 26% in year 3. Okay, what else? 6155. Okay, I'm going to do 2 more and then I'm going to stop. Okay, this is a WA postcode, and there we're looking at places like Canning Vale and Williston. 17,000 households, 10,000 borrowing, 4,000 renting, 36% in financial stress, 37% in mortgage stress, 27% in rental stress, and 20% of investor stress. And we're looking at a 6% fall or 5% fall in the first year, followed by a 12% fall in the second year, followed by an 18% fall in the third year in my mid scenario. But if you actually take my more positive scenario, there's almost nothing in the first 12 months. So I've done that one. I've done that one. 2777. I don't think I've done that. I'll try that one. So tell me what you think of the tool. What do you think? Is it useful? If it's made available, would it be a helpful tool to have? 2777, 6,879, 6,789, 3,600 borrowing, and 19% in financial stress, 19% in mortgage stress, 13% in rental stress, and 17% investors stress. So as a result of that, the fall is 6% in the first year, 12% in the second year, and 16% in the third year. Okay, I'm pretty much done, I think. Have I missed any? 2230. Did I do 2230? Hang on, let's do that one. It always goes the same way, doesn't it? We end up, did Cronulla, did that one? Yeah. All right. Jolene asked, how much gold and silver do we need to be prepared for the GFC? We have a mortgage debt of 500,000. One of my little jokes is I've actually been able to track prices to ounces of gold. So that may be something we'll put into the model. I don't know the particular answer to that question. Okay, well, we're at 9:26. I'm about to just to go back to the slideshow and just finish off. So just in terms of more information, if you want more information about DFA, go to the DFA blog. Always stuff there. You can sign up and get more information. You can also support our work at Patreon, and in fact, you can get the stress data, the whole series of stress data, by subscribing for $50 a month. Those who have subscribed, I'll be releasing the August data in about 2 days' time. But there are other levels there that you can look at and get exclusive additional content as well. There's also this DFA 1-to-1, which is essentially individual confidential discussion with me. I can't give specific advice, but I can talk about a postcode. I can assemble stress data, all that information. You can book a time for a Zoom or a phone call up to an hour. It's $100 plus GST. That's really just to cover my costs and to make sure that we have people who are serious. And at the moment, spaces are limited. I'm booking 3 to 5 weeks out. And anybody who's sent me a request and I've responded or haven't responded, give me a poke if you've not received what you expected to receive. I've got a lot of questions and queries, and my emails seem to be going astray occasionally. So just to warn people. You can make a contribution via PayPal if you'd like to do that. That's a simple, straightforward way, and people have done that. Appreciate it. Or even Bitcoin. There's a QR code there. Or Merc. I've talked about the merch that we have on the site already, mugs and things. Top hits this month, Edwin's property rant. We started yesterday. We'll do some more of that each week. Edwin is just on the nail in terms of what's going on with property, so you'll learn a lot there. I've spoken about stressing about financial stress. If you want to know how we calculate financial stress, I did a show on that a couple of days ago. I talked about the central banks and what they were doing. That we did a show with Robbie about bail-in, just in terms of worth thinking about that. And then I also did a show on property prices. Will they double every 7 years? Right? No, they don't. But a lot of people still believe it. So that's another show that you might want to have a look at. Next week, on the 8th of September, we'll have Tony LaCantro on with some straight talking. And he'll be talking about his small caps, and he'll be talking about his perspective on property. Remember, he had the bet with the kook about whether prices would go up or down and how much. So it's quite interesting to have him back on. So he's agreed to come on next week. The following week, I will update my financial confidence index. The week after that, I have Chris Bates, mortgage broker, coming on. And so there's some nice guests sort of sorted out, and we've got some other people planned for later. So I've pretty much run out of time tonight, and I haven't necessarily answered everybody's questions. I apologise for that. If you would like your answer privately, just drop me a note on the DFA blog, and I'll make sure that over the next 2 or 3 days I send you back the picture, the one-page picture that you've seen tonight from the show. I want to say thank you very much for spending some time with me, and I hope you've learned something from this tonight. You've learned something over the last little while. Plenty of stuff to talk about in future shows. We never get through all the questions, unfortunately. It's just way too many, but I will just call out those who've contributed. Thank you very much. If I can, I will answer any others privately, or indeed what I might do is just make a show where I actually just go through postcodes just to cover them off. Gold, Silver, Crypto says, if I sign up for the $50 a month on Patreon, this is what I get as part of a mortgage stress data report. So basically you get the stress data, all that information for every single postcode in the country every month for as long as you subscribe in a spreadsheet format. So that's what that $50 thing is. And we've got quite a few people who've used that on an ongoing basis. So thank you very much, one and all. Thank you, Plexus, for doing what you do so well in terms of moderating. Thank you very much for watching. We had a good number on again tonight. Good to see people on. And what I would want to say finally is go careful. Don't make any jump decisions with regard to property at the moment. Do plenty of research, get more information. If we can help, that's good, but there are lots of other sources too. And remember that prices look as though they're on the way down, and it may well be that the main in-stream indices are not telling the full story at this stage, because in some cases the information is rather delayed. So thank you once again. Apologies if I didn't get to your specific question. I will try to do better next time, but as you saw, I did the best I could. This is Martin North from Digital Finance Analytics, signing off, and take care. We'll see you next time. Good night.